Yeah, go ahead. All right. I guess we're going live now. Vince, how you doing, buddy?
All right. Good to be live with you, Russ. Doing great. How are you, bud?
Yes, sir. I'm excited to keep delivering value for our realtor partners across the country. For those of you who are joining us for the first time, the Quarantine Realtor has been meeting now. This is the 6th week during the COVID pandemic that we're spending time together with our realtor referral partners. We have a special guest on today, Mr. Vincent Gui, the Vice President of Retail Sales for all of the AnnieMac Nation and all the AnnieMac mortgage professionals across the country. Today, we're going to dig into some questions that have been bothering the realtors across the country, some things that have just been weighing heavy on their minds as far as what they can expect from us as a mortgage bank, but also the mortgage industry as a whole. So we asked Vincent Gui to come on today to answer some of those questions for you guys. And before I do, I just want to congratulate some of our realtor referral partners from across the country for really putting into practice what they learned during week 2. We did a special session in week 2, and if you haven't seen it yet, go back and watch it on YouTube. It was an important day for a lot of our real estate referral partners. A Keller Williams team leader down in Fort Lauderdale by me wrote me, and I actually picked up the phone and called him. He said he was in week 2, and he went ahead and took action with those handwritten notes, those absentee owner notes that we talked about during week 2. And I'll tell you what, guys, he took 3 calls on 40 notes. I wish there was a mathematical equation that could produce listings from 40 handwritten notes. But so with less than $20 invested, he's gotten 3, count them, 3 listing inquiries, and he's already taken 1 listing for $475. I heard the same thing from Jacksonville, Florida. I heard the same thing from a group of realtors in the Northeast up by Boston that started sending those handwritten notes out and just had fantastic success with them. So a big thank you to AnnieMac Home Mortgage for sponsoring the Quarantine Realtor, all the mortgage professionals from across the country that have been promoting it and working with their realtor referral partners on things with the Quarantine Realtor. But especially if you're just joining us for the first time here during week 6, go back to week 2 and take action. One realtor told me that his whole weekly ritual changed based on that absentee owner program. He's setting aside 2 hours a week, time blocking, to go out and take those listings. And it's not often that a mortgage bank is concerned about your listing inventory, but AnnieMac is. And the reason that we're so committed to helping you take more listings in 2020 is because we know the math. A new listing produces buyers for weeks and weeks and weeks. And if we can partner with you as a real estate agent and help you take more listings, you're going to have more buyers, more pre-qualifications, and more contracts to process than you will if you don't have any listing inventory. So get out there and work those listings and do your thing. So today's a special day. Vince and I have been working together for, you're going to celebrate your 8-year anniversary at AnnieMac Home Mortgage here in a month.
8 years, brother. 8 years. 8 glorious years, Ross, we've been together.
8 years of you and I. Who would have thought it, right? But we've been thrilled. We've done so many branch expansions into new markets together, you and I. And we've done so many things to grow the AnnieMac sales force. And I just want to tell you, every week somebody mentions how you stepped in and helped them run their branch. You stepped in and helped them increase their sales. And I'm really proud to have you on today. I appreciate it, pal.
I appreciate it, Ross. Appreciate you having me on. And, what AnnieMac Works has brought, to our realtor partners has been nothing short of amazing. We were going back, like you said, a lot of years, and went back, and the goal was to bring value, right, and bring knowledge, and bring education, bring training, bring technology, and bring more than what the average lender was always bringing to the table. We've talked about, the donuts and the rate sheets, and give me your deals, I'm your deal doctor, et cetera. And you've always provided so much value to our realtor partners, and now in a time like this, in particular, the spotlight's really shining, and it's great that we're continuing to do it, and we're doing it now where it's timely and really important information and knowledge that we're gonna review today. So excited to be here, Ross. I appreciate it.
Amen. I'm happy about it. And I don't know if it's true, but it feels like we're starting to see light at the end of the tunnel. Little sparks of the economy opening back up. Restaurants, takeout, but also just people seem to be hopeful that the next 2, 3, 4 weeks we might be able to get back to a new normal, if nothing else. So these are real important questions for everybody. I also want to note, before I get into the realtor questions, you guys have been having some record months here at Annie Mac Home Mortgage. The COVID pandemic hasn't slowed you down at all. It's been a busy time for you guys, hasn't it?
Yeah, you know what? We're blessed, Russ. I mean, we've got such a dynamic, tremendous team, and got to start with our operations and sales folks first and foremost. I mean, for them to be able to digest all these changes, credit policy changes, market changes, and digest all that, be able to work with that at the same time. We literally just in April had our biggest month in company history, and to be able to do that while working from home, while dealing with all these changes, and to be able to do it with still maintaining, consistent service levels, it's just nothing short of remarkable. And we've got a great sales force, got a great got great leaders and folks that are on the ground. But I got to start with that operations and support team. They've just been unbelievable throughout this time.
Amen. We've all the realtors have to deal with these changes as well. So that's what today's session is about. What challenges are we facing in the mortgage and real estate industries caused by COVID in your mind? Like, just, what's the first thing that comes to mind that we're really dealing with right now?
Yeah, well, our whole way of life obviously has changed, and mortgage and real estate are no different. So the biggest piece that's affecting the mortgage end of it, and certainly real estate, is the huge level of unemployment that we're experiencing. I mean, we're upwards 30 million people that have filed for unemployment. So when you talk about 30 million people in the span of basically 45, 60 days roughly. It's just unprecedented levels of unemployment. And then you factor in the unemployment piece, and then the fact that the government has also said, hey, and rightfully so, we don't want to foreclose on your home. We don't want to evict you from your lease. So, they have forbearance options now that they can take advantage of. So the biggest thing really has been, the level of unemployment, which brings a whole new level of risk which common sense risk, and then some risk that some people don't necessarily know or understand what happens in the capital markets and in secondary and sort of the back end of the transaction. But you can imagine people losing their jobs. It's going to mean they're probably not going to be making their mortgage payments. There's a whole sort of domino effect, from there. And then the forbearance thing is there to help consumers, but at the same time, there's a lot of misinformation or lack of information with respect to forbearance too.
Yeah. So can you define what forbearance means from a homeowner's point of view?
Yeah. So it's not forgiveness, right? So it's forbearance. So at the end of the day, what forbearance is doing is you're deferring your obligation, right? So it still needs to be paid. So if your mortgage, as an example, just keep the math easy. If your mortgage payment is $2,000 a month, if you elect to go into forbearance, you don't have to pay that $2,000 a month. But it is going to come due. It's just a matter of when you pay it back. Most lenders are giving sort of a 3-month forbearance, out of the gate, that folks need to take advantage of. it. And then the repayment on that is typically it's an option between paying the whole $6,000 or the whole 3 payments if you're ready and willing and back to work. If you're not, there's an extension on that forbearance period. What a lot of people are doing is when they're back to work, they're working a plan where whatever was deferred is then being worked into the monthly payment or is being added on to the back of the loan. So if you have 6,000 as an example outstanding, you may say, okay, 6,000, we're going to add $500 a month to our monthly payment for the next, whatever, 12 months or so until we're caught up. Or some lenders, like I said, are doing it on the back end. But that's basically what forbearance is. Now, unfortunately, some people are taking advantage or using forbearance when they don't necessarily need to. And there's also credit implications to forbearance, right? And what we can best disseminate, right now is that it's not going to affect your FICO score, which is good, but could affect your ability to borrow in the short term, in the next 12 months or so. But we can get into a little bit more of that.
Yeah. So it's it's almost like the public at large says, "Oh, I get no mortgage payment for 3 or 4 months," but in reality, it's really just another form of a loan. You're just borrowing that money from yourself. Really, you're going to have to pay it back, right?
Exactly.
Yeah.
Exactly right. Yeah.
So how does that feel on the mortgage servicer side of the fence? How does that same process look from a mortgage servicer's viewpoint?
Well, if you're servicing a lot of mortgage loans, it's going to have a major impact on your cash, on the capital of a mortgage company. So, depending on what type of loan it is, meaning is it a FHA, a VA, USDA, or a Fannie Mae, Freddie Mac product, there's different ways on how that forbearance is affecting you. And then also at what stage is the loan in, sort of post-closing, how is that forbearance affecting you? So as an example, you can close, so a client can literally close a loan today, and tomorrow they can call their lender and say, hey, I want to elect to take forbearance and not have to make a mortgage payment for the next 3 months. So from a mortgage lender standpoint, a lot of that was unclear. Fannie Mae and Freddie Mac and the agencies basically said, okay, if that happens, you're going to have to, as a lender, you're going to have to pay 5 to 7 points in order to sell that loan to us that's in forbearance. So if you're doing a $200,000 loan, that's $10,000 to $14,000 upfront that the lender's having to pay. If that loan, like for example, if that loan were a cash out refinance, so someone takes a cash out refinance, they pay off debt, they pull equity out of their home, and they don't make that first payment, or they elect to go into forbearance right away, the lender's on the hook for that 100%. So if it's a $200,000 loan, the lender's on the hook for $200,000. Now, could they sell it in the secondary market for scratch and dent? At the end of the day, it's a major, major expense. And then down the road, as if clients are not making their mortgage payments, or there's EPD risk, as we know, early payment default, and then also the lender may have to front the mortgage payments for the borrowers as well. So you've probably heard a little bit in the news about these large lenders who have huge servicing portfolios, the amount of cash in the billions that lenders will basically have to front for their borrowers if they default, or if they go into forbearance. Either way, those payments need to be made.
How do you feel like Annie Mac's dealing with that on the servicing portfolio now? Do you feel like it's pretty comfortable position, or you're learning about it every day?
Yeah, well, we're in a fortunate position. So our servicing portfolio relative to the size of Annie Mac is relatively small. You have some companies who may do a large amount in volume, let's say $10 billion a year, but they might have a $50 billion, $100 billion servicing portfolio. That's a major issue when you've got, realistically an unemployment rate of 15, 20, 25% potentially. What normally would be, in the low single digits defaults, now you're, 10, 15 times that, potentially. So fortunately for Annie Mac, we have a servicing portfolio. We have about $1 billion under servicing. So relative to the size that we are and the volume that we do, it's not a huge, it's still exposure, but it's not a huge risk. And it's also allowing us to be nimble and agile, if you will, during this time. So we'll get into it here in a moment, but part of it, depending on the lender investor's risk and sort of their legacy, that's kind of dictating what they're able to do today based off of those risks. So you've seen, huge variances in what people can qualify for based on FICO score and debt to income and et cetera, et cetera. A lot of those variances are based off of kind of the position the lender was in. And let me just say this, Russ, it's, no one was prepared for this, right?
Right.
The big boys weren't, the small mortgage broker wasn't, we certainly weren't. We find ourselves in a good position, a company that's well capitalized, not a lot of exposure on the servicing front, and a strong support team. But no one was really prepared for this.
Yeah, it's been a wild ride. Are there any other ramifications that you can think about that are happening now and how the industry's dealing with it? I mean, other than the forbearance issue and the extra work they have to do in operations to prepare for a closing today, is there anything that's standing out to you about ramifications that are hitting the industry right now?
Yeah, I mean, those are the major pieces. Like I said, the fact where you could, I mean, just it seems like there's something new happening still on a regular basis, But as of right now, I think we've sort of got our arms around it, and those are the primary points of exposure or risk, if you will. But still yet to be told, or we'll see. Like you said earlier, are we? It seems like we're seeing the light at the end of the tunnel. But as we start to get away from this, as we start to kind of get back to work and we get away from the stay-at-home requirement for a lot of states, what happens, right? Do we get a flare-up again? Do we go back? What does that mean? Is there more stimulus? So those are sort of still a lot of the unknowns that are in front of us, Russ, that no one really knows what that's going to look like exactly.
So in anticipation of you coming on, we put the word out to our realtor partners that we wanted any of the questions that were bothering them or that they were thinking about relative to the mortgage and real estate industry. I have a few for you, and we'll see how they go. So one of our realtors from Vegas, Las Vegas, Nevada, said that her sister was closing on a house last week, and the closing was delayed by 3 days. She made a point to say that it wasn't an Annie Mac deal. It was another lender that had bumped it out a few days in delay. And they said that the delay was to re-verify her employment, even though they already had pay stubs, they had 5-year work history. And she's just like, why would the deal be delayed for verification of employment when they've already done that?
Yeah. Well, I guess the short answer there is that because there is so much change that's happening, people are getting laid off and furloughed and are collecting unemployment, still continuing to happen, sort of that cascade, that there could very well be someone who had a pay stub 30, 60 days ago, 5 years of employment, but then lost their job in the last week or two, or their hours could have been cut, or their overtime that they were used to making, has now been reduced. So, that is what lenders are trying to sort of handicap, is what's the risk, for this loan to either end up in a default or end up in a scenario where they are where they are having to take the forbearance option. So that's basically it. We normally would go with 60 days worth of pay stub that was 60 days old, but so much can happen here in 60 days. If you're a business owner, you could be out of business. If you're someone who's working and your hours could be cut, you could be furloughed, you could be laid off. So that's why the verification of employment closer to the closing date. Some lenders are doing it the day of, believe it or not, the day of closing, which is presenting service challenges for obvious reasons. We're also doing a verification of employment the day before, within 3 days of the closing date. So the closer you get there, the less risk. But then you've got to take into account these delays. And the other challenge too, Russ, is that, which is, I'm speculating here, but what may have caused some of this delay is, you try and get a verification of employment from an employer who's no one's in the office, right? So you're trying to hunt people down. You're trying to email. Where can I find the HR person? They're working from home. It's not exactly a great process or a great environment for quick communication, quick response times. And then depending on what their own backlogs are like at that particular lender, it may be just exacerbating the problem. But that's, in essence, that's sort of the why behind it. And there's varying degrees as far as how that's affecting folks' closings. And
if there's one word that's been coming up, if there's been one word that's been coming up a lot, it's the word unprecedented, right? It's like nobody's ever dealt with this before. So knowing that so many people are unemployed, it's reasonable to expect a re-verification of employment. But another realtor friend from Portland, Oregon, beautiful part of the country, said If
Absolutely.
his client has his house for sale, he has a listing right now, and that same client that has their home listed is electing forbearance, are they actually like three months behind on his mortgage payment when he accepts an offer? Will that deal still be able to close, and how will that affect his payoff? Can you just touch on that real quick?
Yeah, great question, actually. Yes. So the deal can absolutely close. So we're talking about the seller, right? That's in the forbearance period currently, right? So the deal can close. It will affect the payoff, so that they're going to have to get a payoff, which includes it's going to have to include the forbearance amount. So if they owed $200,000 in their mortgage and they're, two payments into forbearance, that extra, assuming it was $2,000 a month, that extra $4,000 is going to have to be included in the payoff. So it will change their proceeds. It's not going to affect the credit score for the seller, so that's the good thing. That's the good news. The bad news or the challenge is that from what we can tell, it looks like they're not going to be able to get mortgage financing for the next 12 months based on what Fannie and Freddie are saying. So anyone who elects to take forbearance today, not going to have a negative impact on your credit, but it will say on your credit report that you were in a forbearance program, and the guidance we're getting from the agencies they're going to need to see 12 months of good payment history out of the forbearance before they can qualify for a mortgage again. So not going to necessarily hurt the sale, but if that seller is buying another home, it will absolutely have an impact on that. So if you're 6 months into your forbearance, remember you need 12 months clean after the forbearance. So if you're 3 or 6 months in, you might be looking at a 18-month window, 24-month window, depending on how long you need that forbearance before you can qualify again for a mortgage.
So if I'm a listing agent and my client is considering forbearance, I want to have that conversation with them and explain that it might delay their process for getting a new mortgage. My advice would be just make your mortgage payments on time, and we don't have to worry about that unless you're really in a crisis. Then you might have to pay.
100%. Education and advising the client there is key. If the cash is there and they're able to make the payment, because at the end of the day, it's 6 of one or half dozen of the other in terms of what your proceeds are going to be at the end of the day, and at least you won't have a delay in terms of getting financing down the road. Absolutely.
Yeah, I think it really pays. I've been on enough listing appointments to know that those questions are going to come up, and those realtors need to be armed with all the information. So that's a really important question. Another interesting question from Orlando, Florida realtor. And this was all over the news about 3 weeks ago. It was freaking everybody out because they don't really understand it, right? So they say, wait a minute, if the Fed just lowered the interest rates to at or near zero, why did I just get quoted 4.5% if I have 20% down with a 680 credit score? And again, they didn't mention that it was not an Annie Mac quote, but they were just curious, why the heck are they getting quoted 4.5 when they're at or near zero Fed? Can you explain that for a layperson?
Of course. And this is one of the hardest things to explain a couple months ago, right? And now we've got so much else. It seems like it's happened, but yeah, I mean the reality is that the Fed funds rate, or mortgage interest rates rather, are tied to mortgage-backed securities, or what's known as the MBS, right? So the Fed funds rate and the MBS don't have a direct correlation or relationship. So the Fed funds rate is what the Fed is the overnight rate that they lend to banks. Mortgage-backed securities is what, and which is closer tied to the T-bill, is what drives mortgage interest rates. So that's why the 30-year fixed rate is at the time was at 4.5, and today's market closer to 3.5. But there's no direct tie between the Fed funds rate and that rate. And we've seen that, if you recall, especially if you go back some, when I remember when Alan Greenspan was the Fed president, and back in sort of the pre-subprime collapse days, and we saw that prime rate, kept dropping. There was a lot of times where the prime rate or the Fed funds rate kept dropping and mortgage rates were going up, right? And vice versa. So sometimes there's an inverse relationship there, but there's no direct relationship. We'd love to be able to, offer 0% mortgage loans today. Pretty good deals on car loans out there, from what I understand. You can get 0% on and low interest rates on personal loans and car loans, but not a direct correlation with mortgage rates.
Okay, that makes sense. What are you recommending to clients, or what should the realtors be advising? Is it time to lock, or is it time to float? I mean, what are people doing right now, or what are you guys recommending?
Yeah, good, great question. And none of us have a crystal ball, right? So we are and right now we're in such a volatile time that if you have an interest rate that you qualify for and you're happy with it and it's helping you accomplish your goals, my advice would be to go ahead and lock it in. I mean, the long-term perspective, so that's sort of within a transaction, right? So we're talking between that 30 to 45-day period. You get the interest rate you need, you qualify for it, get it locked in. No reason to have exposure for a higher rate, in my opinion. Long-term, if we're looking at 6 months, 12 months down the road, I think most folks believe that rates are going to be lower. And quite honestly, most people that you talk to will tell you that if we're at that, if we're in the low threes now, we could be potentially a sub 3 on the 30-year fixed rate, long term. But if I'm in the middle of a transaction right now, I'm not trying to play the market and try and save myself, try and mess around with it, try and get an eighth of a point better in my interest rate. I want to have that peace of mind, get it locked in, and have the peace of mind and get it done.
And when I started selling real estate in the late 80s, it was 10 and 11% interest rates. So seeing 3.5 on a mortgage is pretty fun, and people should be taking advantage of it, right?
Yeah, it's so funny you said that. I was watching Rocky 2 the other night, right? So Rocky 2, I think, was like late 70s, I think, early 80s. And if you remember the scene when Rocky and Adrian are looking at their first house, and Adrian's like, I got a good deal on the mortgage, I got it 9.5%. He's like, okay, Adrian, we're gonna go and get that, sure. But I mean, just kind of put things in perspective. I mean, that was was a low rate.
Yeah, I'm gonna put that up on social media this week. That Rocky quote. I think that's funny. I did get a couple questions in our text chat. They're not on our original questions from our realtors. One of them is the word deferment and forbearance interchangeable? Is that basically the same term?
Yeah.
Or is that a different term altogether? Forbearance versus the word
I would
deferment.
say, it's synonymous because you're deferring it, but it's not being forgiven, right? So I would say forbearance and deferment are essentially the same thing.
Okay. One more question off the cuff on the text chat is being affected. I think that's pretty obviously the case. Yes. In other words, some lenders are being forced to raise their credit standards in this time right now. Is that happening?
Yeah. Great question. So certain lenders are raising their FICO standards, or their minimum FICO score, if you will. Or maybe their maximum debt to income ratio is being reduced in order to mitigate the risk, or it may also be a way to sort of reduce some of the volume. So certain lenders that don't have a capacity, and when I say capacity, that means not just the ability to underwrite and close loans, but also the capacity to have the warehouse, the cash flow, if you will, the warehouse line providers. In order to close the amount of volume that they have coming in. So there's a combination of things happening there, but either they're trying, they've already got issues because they have a large servicing portfolio, so they don't want to add any more or take on any more risk, or there's some layering, if you will, of overlays in there from a higher FICO or a guideline perspective to help kind of stem off some of the volume as well. And you're seeing that with pricing. Same thing goes with pricing. You can, if lenders are charging you're kind of seeing, certain lenders, if their FICO score sort of, they want to be at a 660, you'll see interest rates below a 660 FICO that are just unattainable to get, right? Because they just kind of want to set that market 660 and greater. And they're either balancing the risk on the credit piece, or they're trying to manage their capacity in terms of what they can handle.
Is AnnieMac in fact still lending down to 580, or has that changed during the last 90 days?
Yeah, no, glad you asked. So we're lending down to 580. So Fannie Mae, Freddie Mac, Ginnie Mae, FHA has not changed their rules. They're still 580 and greater. It's basically the lender or the investor that is then imposing their overlays on top of that, right? So AnnieMac pre-coronavirus. didn't have was 580. 580 was our minimum FICO score. Today, it's still 580. What we did was we added in some overlays between 580 and 640 to help mitigate some of that risk. So things like a couple months worth of payment reserves, a DTI max, things of that nature. If you're renting, we want to get a verification of rent, from your previous landlord, things like that to mitigate that risk. But we're still going down. We're still going down to 580, and basically 640 and greater. As far as any MAC is concerned, there are no overlays. It's just straight from your regular what we call a DU or an LP approval from the automatic underwriting.
Are there any products at AnnieMac that have been curtailed during this, like the 203K program or any particular USDA no money down programs or anything like that? Or is it business as usual with product availability?
Yeah, so industry-wide, you've seen the non-QM products be suspended. That's not just AnnieMac, that's every lender, every investor out there, the non-QM. So the loans that were, portfolio loans, if you had a business owner who didn't show their income on the tax returns, but they had cash flow, the foreign national programs, all those sort of non-QM niche type programs have been suspended across the board. A lot of lenders, like I said, have suspended below certain FICO bands. AnnieMac is not doing that. We've added some overlays there, but we're not suspending it. We are still doing renovation loans. A lot of those have been suspended as well, but AnnieMac is still doing renovation loans. The jumbo market's difficult as well, so I kind of put that in the same category as the non-QM. The only product that we've really suspended on our end as of right now is our one-time close construction to perm. So other than that, AnnieMac pretty much has their full. And you've seen some of the some of the bond programs, depending on the state, some of that's been pulled back. But we've pretty much have kept our full product portfolio open, minus the couple that I mentioned.
Yeah, that question came from one of the realtors during text chat. But for the realtors who are online for the first time today or getting to know us better at AnnieMac Home Mortgage and AnnieMac Works, check out the renovation real estate certification available through AnnieMac Works. It's a free program taught by Kevin and Landy that run the renovation lending division for AnnieMac Home Mortgage. I think it's certainly one of the programs that I'm most proud of. It's changed the lives of some of our realtor referral partners, and it's also changed the lives of some of our borrowers to be able to buy the house that they envision, that they might not be able to afford on that first mortgage, but they can renovate something and make it the house of their dreams, kind of Joanne and Chip Gaines like, right? Going out and finding one and making it hot. So that's a great program. Exclusive to AnnieMac Home Mortgage and AnnieMac Works. Check out that renovation lending certification. Let me get to the next question for you. Vince, from another realtor, what are experts expecting or how do you see the residential resale market shaping up this year? Do you think there's going to be a drop in values? Do you think there's going to be, interest rates rising or falling? I mean, just how are you speculating on the next, say, six or 12 months of this residential real estate market after this?
Yeah, I think the job market has a lot to do with it. If you ever heard Joe Ponabianco, our CEO, talk, he's always said home values are much more dependent on jobs than they are really on interest rates, right? So I think if our economy is closer to a V-shaped recovery as opposed to an elongated recovery, and that's all yet to be determined, that'll be good for residential real estate. I can tell you that the mortgage interest rates are going to be very low, for the foreseeable future, and I'm talking about into 2021. So from that standpoint, the affordability piece will be there. Then it's just a matter of how's our economy doing, how's our job market doing, and that's also a little bit market-driven as well. You're going to be in certain markets where I can tell you right now that there is, from anecdotally, I can tell you this. This is not, any sort of economic outlook, but anecdotally, I can tell you that certain states that are starting to open up, there's some pent-up demand. I was talking to a friend of mine in Michigan, and they reopened their real estate brokerage 2 days ago. And on the first day they reopened, it was like 24 listings came in, 17 buyer contracts. It was like it just kind of flooded, So I think we'll see some of that. There seems to be some pent-up demand. But, beyond that, sort of like I said, no one has a crystal ball. This is uncharted, unprecedented times. But we can count on a good interest rate environment. We can count on a government, I will say, that is, I mean, we rolled out trillions already in stimulus, and I think there's more, coming behind that, including a potential infrastructure bill that could create a lot of jobs for us on a go forward. So I'm bullish on the residential real estate market. I think if right now I probably wouldn't be buying for a short term pickup, obviously. But if you're on the long game on real estate, I think we're going to be just fine. We had a very good economy, maybe arguably the best ever before this happened, and all those fundamentals, right, are still there. When you remove the fear of going out in public, when you remove people not living their lives the way they normally would, I have a feeling that's going to put us in a great spot moving forward. We're very bullish on the future from a mortgage industry perspective, that's for sure.
Interesting, because the very first week of the quarantine realtor, we said, if you get in the boat and row right now during, April, as you enter, you could have the best summer you've ever had. I mean, in the mortgage industry or in the real estate industry, because of that pent up demand. Those listings are ready to get listed and those buyers are ready to buy. It doesn't seem like it's going to, it feels like it's going to hit the ground running, just like you mentioned.
Yeah.
Hoping.
Agreed.
So the question was, should I wait or buy now? Float my
Okay, I think Russ.
Vince, do you have
Russ, it sounds
anything
like
else to add before we wrap? We start to wrap. Closing. You froze.
Okay. Can you hear me? Yeah, you're looking good now. You were getting a little choppy on me there for a minute.
I was just asking
there,
if you had any closing statements or anything that you wanted to share with our realtor referral partners from across the country before we wrap up.
Oh yeah. So thanks again, Russ, for having me and giving a chance to share and to talk through some of this stuff. If anyone is having if anyone needs any more information or has some deeper questions or is interested in what AnyMac Works can do and some of the products that we have available and how we can help be a partner with you, by all means, please reach out to us. We'll connect you with a local loan officer. If one of your loan officers, of course, invited you to this broadcast, and would say, sit down and we can be happy to kind of give you some education, let you know where things are. But we really just appreciate the relationship and also the time, that we're in right now. So want everybody to stay safe, want us to get back to normal as soon as we possibly can. And, we will ultimately, we've been through some difficult times, as loan officers and realtors. We're a resilient bunch. We've been beat down before, and we've been through challenges before. And as we say, it might be a cliche, but it's so true. What doesn't kill us is ultimately going to make us stronger. So, we're here for you. We're here as a resource. And, again, we're excited about our future together.
Amen. Well, thank you very much. That was Vincent Gui, the Vice President of Retail Sales for AnyMac Home Mortgage, jumping in to kind of answer all the realtor questions from across the country. I just want to say we're going to do this one more time next week, week 7. We're going to focus on what's next in residential real estate and the mortgage markets. We're going to focus on how that original business plan from the quarantine realtor can really manifest itself into May, June, and July of 2020. So one more big thank you to all the AnyMac Home Mortgage professionals from across the country. Huge thank you to the broker owners and the team leaders, the sales managers that have been promoting the quarantine realtor to their groups. And also, one last time, thank you to all the realtor referral partners from across the country who depend on AnyMac Home Mortgage to get those deals closed on time and keep your clients happy so that we can build a long-lasting relationship between AnyMac Home Mortgage and the real estate community. So one more thank you to Vince, and I'll see you guys next week on Wednesday live at 5. Thanks again, Vince.
Awesome. Thanks, buddy. Stay well, everyone.
See ya.